Hello guys, this is Renkat on Renkastar FX. Today I'll be talking about risks in the Forex market. A lot of people ask questions about Forex market. That is there risks in the Forex market? Is Forex market a risk-free? And there are 6 major risk factors in the Forex industry. Number 1 is leverage risks. High leverage product has high risks. Due to the limited capital from traders and investors, liquidity providers provide leverage to retail traders and investors to enable conducting substantial foreign currency trades. An initial investment will be required of you, which serves as a margin. Under high volatility or adverse conditions in the market and the margin level is low, a margin call will be activated. The investors and traders will have to pay additional money to increase their margin level and to keep the opening positions running, or else the broker closes the trade positions automatically. And this results in a big substantial loss. So high leverage or low margin level leads to high risks. Number 2 is transaction risks. The risk related to time difference between contract commencement and a settlement is known as the transaction risk. This is one of the main risk factors in the Forex trading and is contingent on exchange rate changes. Since Forex trading is active round the clock, exchange rates are subjected to change before trade settles. So you can trade currencies at different rates at different times of the day. The longer the duration between entering and settling a trade, the greater the risk. So with fluctuation in exchange risks, traders may face excessive transaction costs. Number 3 is interest risks. When a particular country interest rate goes up, internal investors may look to increase their investment in the country, boosting or increasing the demand and thus the price of that currency. And declining the interest rate may also bring down that country's currencies due to the withdrawal of investment. So this may result to an unexpected move of price and most likely leads to considerable losses. And number 4, country and liquidity risks. In the multiple developing nations, the currency exchange rate depends on a leading currency, such as the USD. In order to ensure that exchange rate is maintained, the developing countries must have sufficient reserves. Now, if there are frequent deficits in payment, the developing country may face a significant currency devaluations. This in turn affects the prices in the forex market. It can prompt investors to withdraw to avoid losses in the anticipation of the currency crisis. And these, together with government restrictions and policies, lead to low liquidity in the market. And brokers increase spreads in the low liquidity market. When there is low liquidity, there will be high volatility, and this results to losses for traders on low margin. Now, number 5 of the risk factors is counterparty risks. In the financial transaction, the company that deals the assets to the interested investor is known as the counterparty or a broker. Sometimes brokers may fail to execute a certain transaction due to the high volatility in the market. This mostly happens during big news in the market. As a result, the trader may suffer losses. For instance, you want to close a trade to reduce losses during a high volatility, but broker refuses to execute trades until it hits your stop loss or wipe your account balance when there was no stop loss at all. Number 6, which is the last risk factor, the credit risks. Credit risks refer to the possibility that an outstanding currency position may not be repaid as agreed due to the voluntary or involuntary action by a counterparty. Credit risk concerns only corporations and banks. For individual traders trading on margin, credit risk is low because you're only trading on margin, the little money you put into the trading account. Also, because of the fact that National Future Association (NFA) and Commodity Future Trading Commission (CFTC) regulates the registered brokers or counterparty. Putting your money with the counterparty or brokers that are unregulated by these authorities lead to high risks. So since forex trading involves a degree of speculation and a multitude of international factors, risk is inevitable. Time difference, volatility of leverage trades, and the political issues are few examples of catalysts for the big losses. Moreover, the resultant impact on different countries, financial markets, and currencies can also be significant. However, when done right, under a minimized risk environment or condition, forex can bring great returns. This is Renkat on Renkastar FX. Bye.